pension funds in the UK are forced to invest a lot of their money in gilts by law. So these pension funds, if you would change the law and say, well, you're now free to invest anywhere, they would sell a lot of gilts, bond prices would collapse and so on. And so institutional structure matters. And institutional structure drives bond prices, and gilts are only risk-free because of the institutional setup that you have in the United Kingdom. We see Bank of England now acting as a dealer of last resort, ensuring that there are prices which are stabilized for government bonds. So, you could say, given the institutional structure, the Bank of England normally leave the market alone. But of course, if the bond prices go down too much, then they will intervene and take back the reign of the market. So yeah, it's up to them to decide what bond prices will be and who's setting them.
This is the MMT Podcast with Patricia and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. A big thank you to all of our supporters so far. At the beginning there, you heard our guest this week, economist and author Dr. Dirk Ehnts. And in a moment, we'll be asking the question, are markets running the world, or are they just apps running on a cruft-ridden operating system that is world politics? Either way, updates are overdue, and I think a coder who understands modern monetary theory should write those updates before this metaphor gets stretched any further. If you're new to MMT, you can listen to our first 3 episodes for an introduction, but if you want to dive in here, a way to declutter your thinking about money is to think about it as a tax credit. So a £5 note is a promise to pay off £5 of your tax obligation to the state. And because the only 2 certainties in life are death and taxes, and you're not dead yet, you can see how taxes drive the domestic demand for national currencies. If you're new to government bonds, for the purposes of this conversation, they're called gilts here in the UK, and a gilt is a promise to pay the holder a certain number of pounds at a future date. They have a face value, which is the number of pounds the holder will get when the bond matures, and when you buy a bond for less than its face value, that difference between the price you paid and the face value is the yield. And this is what Dirk means when he talks about prices and yields moving in opposite directions. But for more on that, you can listen to our episodes 30 and 31, which I've linked to in the show notes for this episode, where, as ever, I've linked to where you can support this podcast financially via patreon.com/MMT Podcast. Support starts at $1 a month or £1 a month, or whatever the equivalent is wherever you live. And no matter what level of support you give, you get early access to all of our episodes and patron-only episodes. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. So thanks, as ever, for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT Podcast. I'm Christian Riley.
And I'm Patricia Pino.
And we're delighted to be joined once again today by economist and author Dr. Dirk Ehnts. Thanks for joining us today, Dirk.
Yeah, thanks for having me.
So we wanted to help people understand what's going on in the UK government bond market because it's been a hell of a week. So what happened in the gilt market these last few days?
So what happened in the gilt market is that bond prices first went down, and then the Bank of England intervened and bond prices went up. That's the very short version. So why did bond prices first come down, and what did the Bank of England do to make them go up again? And why did they do it? When the central bank does not directly intervene, and the Bank of England normally doesn't do that, then bond prices are more or less left for the market. So the market will determine the bond prices, and that's always arbitrage. So the bond prices of, let's say, a gilt of 1-year maturity, 5-year maturity, 10-year maturity, the bond yields, so the returns to capital, if you invest into those things, they don't diverge too much, because otherwise you could engage in arbitrage and you could sell, for example, your short-term bonds and buy the long-term bonds if they had way higher yields. So this is what keeps the whole thing together normally. If bond yields go up, so prices and yields move in different directions. So if bond prices are falling and then I buy, I get, of course, a higher return because I bought the gilt cheaper. the bond still pays out at maturity, the full amount, plus interest. So bond prices and yields move in different directions. And if bond prices go down, then it is because apparently on the market, there's lots of players, lots of economic units selling government bonds, gilts into the market. And the question is, of course, why do they do that? Is there any reason to do this? Well, they must have a reason. And it seems like the pension funds were behind this. So it's an institutional kind of question then. So the pension funds, they invest in government bonds because they have to, because it's super safe. The British government does not default. It never happened that the government of the United Kingdom did not pay. So it's super safe. And that's why the regulation regarding the pension funds forces those funds to invest, or funds to invest into these kind of assets like government bonds of Great Britain. Well, then apparently they were having this kind of problem that in the last couple of years, like a decade or maybe a little bit more than a decade, the returns are very low. So interest rates are low, and that also means that yields are low. So government bonds have a very low interest rate, and the pension funds have big problems because they cannot make a lot of money buying government bonds, because the returns are so low and they have to pay out some kind of defined payment, which is not negotiable. So they are forced to make a certain amount of profit in order to be able to pay out. So they need more risk, they need more yield. And it seems like, and this is kind of I think this is not completely right, but this is roughly what's going on. So apparently they buy government bonds and then they pledge them as collateral in order to borrow money and then invest that money into risky assets. So you can just say, okay, I borrow from another financial firm. I borrow, let's say, 100 million pounds, and I pledge as collateral 100 million pounds in treasury bonds or gilts. And then you invest into real estate or some kind of, high-tech stocks or whatever you want, something that is supposed to give you a better return. And then, of course, when something goes wrong in the bond market, meaning that prices in the bond markets are falling for whatever reason, maybe because, some international investors want to go out because they don't trust the economic policies of trickle down that the new Tory government apparently seems to be pushing, then if the bond prices start to fall down, then, of course, the pension funds, they will get a collateral call. Okay, so they borrow money from this one economic unit and they put up collateral yields. And then the other economic unit says, well, the economic value of those yields has been falling because bond prices have collapsed somewhat. So can you give us more as collateral? And that, of course, means that for the pension fund, we have a problem here. In order to hold the position, they would have to give them more collateral. But money apparently doesn't grow on trees. So they don't have that money. And that means they have to move out of their position, selling the risky assets. And if that happens to a lot of pension funds, that bond prices are falling and then they face collateral calls and they don't have the pounds to provide, or they don't have the gilts as collateral to provide to the business partners, then of course they would be forced to sell off whatever they bought with the money they lent. And that would, of course, create a lot of financial distress. And maybe then bond prices would fall some more. And apparently the Bank of England decided that it's not a good idea to have this kind of financial instability. And they're supposed to watch over financial stability. And they decided then to step in. And they said, okay, we want to buy government bonds and pull up the government bond prices. And because they are the creator of currency, they can just ask banks to sell government bonds to them. And they just credit the account of the bank that is selling the gilt. So they pay by money creation. They can do with that until they would have bought all the government bonds outstanding. There's no limit in doing that. So this is what they have done. And this, of course, drove bond prices up again. And then yields came down. And that's where we are right now.
I've spent the day sort of trying to understand interest rate swaps, which apparently are the thing that's at the heart of this pensions crisis. So I'm just going to throw it out there for you guys to comment. You tell me if I've got this right. Interest rate swaps are a bet on what interest rates will do. And this bet is made between two financial institutions, in this case, a pension fund and a bank. And the fund says, I will pay you, the bank, a stream of variable rate interest payments based on a specified principal amount over, say, a 2-year period. Then in return, you, the bank, pay me, the pension fund, a stream of fixed rate interest payments. So we're swapping fixed rate payments for variable rate payments. Both parties agree on which floating rate index they're going to base the variable rate on. I read that that's usually LIBOR. And then this is a way for the pension fund to get liquidity to finance other investments, like you were saying, Dirk. But it's a bet. So someone's going to win and someone's going to lose based on shifts in the interest rate. And what happened this week was a lot of pension funds were on the losing side of the trade, and they faced margin calls, as you say, meaning that they had to make these interim payments to the winners. To get the money to make the payments, they had to sell off their government bonds in a hurry. That increased the supply of the bonds to the market, which pushed down the price of those bonds, pushed up their yields. Does that sound about right to everybody?
Yeah. To me, that whole episode sounds like a really good argument for nationalized pension funds.
Exactly.
I mean, I get that the central bank is sort of reacting, central bank has to deal with whatever happens and it has to do so quickly. But at the same time, shouldn't we be more proactive about these types of events? I mean, if pension funds are taking risks that they shouldn't be taking, then we should start with questioning what they should be doing.
My point in going into all that detail was just to stress that this is a private sector crisis that the government had to mop up, not the other way around, right? Because, there's turbulence like this. Everybody comes out of the woodwork to say, you see that thing that I've been complaining about for years? I told you it would do this. And obviously, the fiscal hawks are like, well, it's profligate government spending that's done this. And it's like, no, and I think what we're saying, Patricia, is this the way we should organise the provisioning of retirees? Should it be based on big corporations betting piles of cash against each other?
That are then too big to fail anyway. If we're going to bail them out, then just nationalise them.
Exactly. Could there perhaps be a better way? I don't know. It's so unclear.
But am I right to say, Dirk, that if long-term gilts have the yield went up, it has to do with the expectation that there is more inflation as a result of the government policies?
Well, no, it can be for whatever reason. If you're an international investor, you don't care about British inflation at all. You care about the exchange rate and you care about your interest rate or the yield that you'll get. But whether the price level in the UK goes up or down, I mean, if you don't live in the UK, why should you care about that? So you just care about the profit. And that means exchange rate and interest rate / yield is what you're watching. And your pension system there is very specific. It's run in a way that I think it's not run in other countries. So of course, you're always trying to go for extra yield if you're the pension fund. But I heard also that most of the pension funds don't accept new customers anymore because they have to promise a certain return to the money invested in that kind of pension fund. And it's incredibly hard to get those returns in this kind of low yield environment that we are still living in. I mean, now yields are going up and interest rates are going up, but it's not really sure whether this is a short-term phenomenon. And then maybe already next year when the Eurozone is in a recession, the whole thing will be going back to zero again. Who knows? So there's a lot of uncertainty. But yeah, I mean, somebody's selling government bonds and this pushes down government bond prices and then pushes up yields. But there could really be any reason. I mean, you would have to ask the people acting in the market what it is that is driving them. But I would guess that they kind of thought, well, what the Tories are doing is they cut taxes for the rich, which means a lot of money, a lot of income will be going towards the rich. What will they do with the money? They won't spend it on consumption. Okay, so if you're an international investor, you would like to see a lot of profits. But if money goes to the rich, they don't buy consumer goods. They already buy a lot. Giving them extra money probably would not increase the amount of money you can make in the UK economy, in the real economy. So the rich people would probably invest, let's say, 1/3 of the money they get by lower tax rates. They would invest 1/3 outside of the UK. So it's kind of logical then that those people who are expecting the real economy in the United Kingdom to do less well than expected because of this trickle-down growth disaster, they are selling their assets from the UK because they think that they cannot make a nice return. And then, of course, everybody else who thinks financially says, well, there's going to be a lot of rich people who want to invest in other currencies. Let's increase the price of other currencies already because they will be willing to pay that now that they have more money. This is the connection, I guess.
What I think is going to happen, I saw a news report very recently that despite the Bank of England sort of increases in interest rates, house prices in the UK hadn't actually gone down, but they had actually edged up slightly. And I think what's going to happen is that as the exchange rate falls, we're going to see more influx of foreigners buying UK property. And that's going to continue to prop up the property market in a way, and obviously enriching the rentier class. I don't know if that means that every single part of the economy will suffer or if those types of assets will continue to benefit. What do you think?
Yeah, I think what's going to happen to the house market is a very, very difficult thing. I mean, it's very difficult to understand. I mean, the logic would say, well, if interest rates go up, then those people who take out new loans, they would have to make more payments to the banks, so they cannot afford to pay very high prices. And in the long term, also, we see then that house prices are connected to income more or less. So, I mean, if wages would grow faster, then of course house prices should also grow again, let's say. But we don't know whether workers will be able to fight for higher wages and get them. And the international situation, I mean, the investors want to see some profits. So, I mean, it's also a question of momentum. So if prices are still going up, then maybe international investors think that maybe now the UK and London maybe is a bargain at the exchange rate that we have right now. But once the prices start falling in nominal terms, international investors might as well say, well, I think this is going to go down. So better get out of the London market before others do. And then you get the other kind of dynamic. So it's incredibly hard to forecast these kind of markets.
So it's all about confidence, and it's really difficult to forecast how long that confidence may last.
Yeah, it's about confidence, but also about institutions and changes in institutions. So will the government give, I don't know, new subsidies for families who want to buy their first home, for example? I mean, this could happen at any time and would create a bigger market again, and it would be creating a new generation of buyers maybe. We have the same thing in Germany now, where the government is saying that they want to subsidize those households which earn less than 60,000 euros a year when they buy their first home. And that, of course, will prop up German property prices. So the problem here is mostly complexity. So there's a lot of things happening at the same time. And then also fundamental uncertainty. You don't know what kind of policies they will come up next. You don't know whether a fall in house prices will cause the public, for example, to exclaim, oh no, this is our wealth. We have to ask our government to do something for us and move prices back up. Or will the public think, oh, that's a great news. Now it's more easily affordable for us to buy a flat or a house. So all of these things are very uncertain. So I think there's no way that we could predict where house prices will be in 1 year, for example.
I think when you got the IMF telling you, even the IMF telling you that your policies are risking inequality, you know you've done pretty bad.
Yeah, that famously woke organization. So concerned with inequality.
Yeah, and I mean, this concern with inequality is also a concern about the real economy, because consumption of the workers is what keeps the real economy afloat. And if you redistribute too much income from poor to rich, then of course you will have a big problem for the business sector. Where should profits be coming from if revenues are decreasing? And especially in industry where you have increasing returns to scale. I mean, you are more efficient if you produce more. So having to reduce output means also that your average costs will go up. Of course, there's not a lot of industrial sectors that are that important in the UK, but there's a significant share of car industry, for example. So it would hurt definitely the United Kingdom car industry.
So, we kind of skipped ahead a little bit where we came in on the current part of the Omni crisis. Before all of this, right after the mini budget, the pound dropped to an all-time low against the dollar. Now, Dirk, would you call that a currency crisis? What is it? What's driving it?
Yeah, no, I think this is just the regular safe haven function of the US dollar in times of crisis, in times of economic problems. So the world economy is surrounded by a lot of uncertainty. We have the war in Ukraine. We have very high energy prices. Apparently, behind the scenes, there's a lot of political pressure. Apparently, there's some kind of coalition between Russia and Iran, and maybe China for a moment had joined, or Saudi Arabia had joined as well. So there's a lot of stuff going on politically that we don't see, I guess. And a lot of people don't know what the future will bring. So the one thing that you do know about the future is that you can use dollars to buy oil. That means that the dollar gets some kind of liquidity bonus, because when you want to buy oil, you can just directly use the dollar. With all the other currencies, you would have to swap your currency first for dollars and then buy oil. So there's always some kind of exchange rate risk involved. So this, I guess, is why many prefer the US dollar to other currencies.
But does that hold even after the war? And given that, the US so freely freezes the assets of foreign countries.
Yeah, Afghanistan, Venezuela, they just kind of go, yeah, you can't have that now. That's on our spreadsheet. I don't know why you put it there, because we just decide you can't have it anymore, right?
Yeah, I think there's still a lot of countries which are friendly to the United States and where this has never happened. And in those countries, portfolios are readjusted, and that's what's going on. I mean, you're right that this kind of reserve currency thing it's not so easy to sustain this kind of position if the Chinese and the Russians, for example, are working on a payment system which would work as an alternative to the system that we have now, and which is American run, the SWIFT system. So maybe in 10 years this will be different, but I think we are not there yet.
But just getting back to this plunge in the pound, I mean, it did plunge after the mini budget. I know that the dollar's been strong, and I believe that is down to them hiking the Fed funds rate. That's led to the strong dollar, as well as the other things you were talking about, the safe haven principle. But what is it that, quote unquote, the markets didn't like about the Kwasi Kwarteng mini budget?
Yeah, I think that's what I was mentioning a minute or two ago, that the market didn't like the lack of profits, the lack of expectations of profits, let's put it like this. So if you give more money to the rich, but you don't give any money to the poor, your economy will not do well, and real economy companies will not have high profits. Plus, you have these expectations that the rich will invest, let's say, a third of their extra saving in foreign currencies. Those effects move the pound down. And I think that is what happened. And of course, it was a speculative movement. So it was expectations of what other people would do. But this is how markets work.
Yeah, it's the not judging the beauty competition, but guessing what you think the judges will plump for. And also this week, on top of the IMF lecturing the new leadership, Moody's, the credit ratings agency, made some strong statement about the UK government's new direction. Do you have any thoughts on that?
Well, I mean, by now the rating agencies say, I mean, it's kind of clear that they don't have a lot of power. Only if you give them the power by, I don't know, inserting ratings into some kind of laws like in the Eurozone, for example.
They did such a good job with the mortgage-backed securities that we're now listening to them regarding undefaultable debt.
Yeah, and then they just claim it's freedom of opinion or something like this. So, I mean, the UK, they have the pound and nothing's going to happen. The central bank, the Bank of England, has stepped in. They stabilized the bond prices. They stabilized the long-term interest rates by doing this. It's something which central banks have been doing for more than a century. So there's really nothing special about it. And Moody's does not have any kind of insight that we don't have. The British government cannot run out of money, full stop.
I think our mutual friend Brian Romanchuk wrote about this a while ago, that the credit agency ratings are really just an op-ed.
Yeah, this kind of stuff, it's creating volatility, and volatility is creating trades, and financial markets earn money when trades are made. There's a book by Michael Pattis from probably now 20 years ago, which is called The Volatility Machine, where he describes this kind of market behavior. And it's the same with Bitcoin. You talk a lot and you're trying to talk up Bitcoin, then you talk down Bitcoin, but it doesn't really matter. I mean, in every trade, you get a fee if you are one of the big traders or trading platforms, and that's how you make your money. So it's the same for financial markets in general. You live off that volatility, and that is why you use these kind of institutions and you put it on the front page, and Moody's downgrading or upgrading or not grading at all.
Yeah.
Doesn't matter. You just try to change expectations. That's what you're trying to do.
Just getting back to the government intervention this week, getting, I think it was the 10-year gilts in the range that the Bank of England considered orderly, quote unquote. They went about that by just buying as many of those gilts as was necessary until the price came into the range that they considered orderly. Is that pretty much the beginning and the end of it?
I don't know what they're doing there. I mean, the wording is strange. The Bank of Japan, for example, that they are pretty straightforward. So they have something which is called yield curve control. And for a while, for example, they had fixed the yield on 10-year government bonds at exactly zero. So whenever bond prices fell and the yield went positive, the Bank of Japan just started to buy as many government bonds 10-year as was necessary to return the yield to zero. And I remember that it must have been 5 years ago, there was because there was a newspaper article in the Financial Times, I believe, and they said that on a single day in Japan, there was not even a single trade of the 10-year maturity government bond. I mean, the size of those bonds is probably in the hundreds of billions, probably trillions of pounds. Not a single trade. Well, everybody knew the price of that, so it was very unattractive to trade. So the yield was fixed, and that's what you can do as a central bank. But in Europe, we haven't caught on to that. So the ECB is not doing it, and the Bank of England apparently is also not doing it. But I think they will come around and start thinking about it pretty soon.
So turning to the Eurozone and the ECB, since we last spoke, there have been changes to the Eurozone fiscal rules. Can you tell us what's changed?
So there was in 2020 in March, they created the Pandemic Emergency Purchase Program, and it was basically serving the same purpose that what the Bank of England just did now. So they wanted to stabilize bond prices and bond yields to make sure also that there's always a demand for government bonds, so that investors could always offload government bonds that they didn't want at stable prices, and they could sell them to the ECB. So that used to be the Pandemic Emergency Purchase Program. The ECB ensured that all the national governments of the Eurozone could spend more money, because when those governments spend more money, they let their accounts at the central bank go negative. And the way to bring it back to zero is through tax revenues. But when these are not enough, especially during a pandemic with lockdowns, then you need to fill them up with bond revenues. And the ECB ensured that there would be enough bond revenues to make sure that the central banks would still make those payments for the national governments. And they kind of stopped that earlier this year. And when they did, I thought, well, this is not going to be the final word. It took about 3 or 4 months, and then yields started to increase again. I think it was Italy, mostly Italy and Spain maybe also. So there were political problems, and it was not sure whether Draghi would stay on and so on. I mean, now it's clear that he doesn't. And he won't. But yeah, they created a new tool. It was called the Transmission Protection Instrument. It's not really clear what it does. Well, it's kind of clear what it does, but it's not really clear how. They said roughly that they can intervene and buy government bonds for as long as necessary and as many as necessary to make sure that fluctuations in bond prices and yields not caused by, let's say, fundamentals, that these can be reduced and neutralized. And they also said that when they would do this, they would consider, I think these were their words, they would consider also the level of public debt, the question of whether the deficit was excessive or not, and so on. But I think that's only politics. That's just talking. They try to honor the words that you have in the European treaties about public sustainability or sustainability of public debt. But I mean, considering these kind of issues doesn't mean that you have to decide and you are bound by these kind of, let's say, deficit limits and so on. So you can always say, well, let's go buy some Italian bonds, even though they don't play by the rules, let's say. So it's a discrete decision by the ECB.
What we're talking about here, yield curve control. In the States, they have a saying, don't fight the Fed. Once everybody figures out what rate the Fed are going for their interest rate target, they're going to hit it. We know they're going to hit it. Just tell us what you want it to be. L. Randall Wray calls it the announcement effect. Are we entering a period where markets are going to have to learn a similar lesson about don't fight the Bank of England, don't fight the Bank of Japan? You know, these yields can be whatever they say. They can't run out of pounds. They can't run out of yen when they want to hit a target.
Yields did collapse immediately after the announcement. Did you see that?
Yeah, I think they're just guessing the probability of the Bank of England intervening. So there's lots of people in the market who believe that the Bank of England would not intervene, which explains that so many people sold government bonds and accepted low prices when selling those things. I mean, the thing is, with government bonds, you normally, if you can just sit and wait, and at maturity, you will get your money anyway. Okay, so market prices for government bonds are not really that important. If you are holding them to collect the money at the end, I mean, let the market price be reduced by half, for example. I mean, if I would be a rich private investor, I wouldn't care about that. So why would I want to sell? So it's a bit strange here that some investors apparently got out of those positions. It's not easy to see who's doing what on the market, driven by what kind of information or ideas about how this whole thing works. But of course, you could have made tons of money if 2 days ago you would have bought gilts at the prices that we had 2 days ago, and then they would have jumped back to today's prices, and you would have made a killing.
In the mainstream commentary around events this week with the yields on government bonds going up, outlets report that as the cost of borrowing faced by the UK government is going up. and that will be unsustainable. What's the problem with that framing?
Yeah, well, the problem of that framing is that they somehow think that the government is a currency user, but they have the support of the currency issuer. So they can just ask the Bank of England to credit bank accounts. They have to issue gilts when they do, but they might as well ask the Bank of England to do that without issuing gilts, which has happened in 2020 in April. Boris Johnson asked the Bank of England to just let the government spend money without issuing government bonds. And the Bank of England, after about a week, said, okay, we would do that. And here's roughly 30 billion of extra funds that you can have. They never used that, but that is how it works. Because the Bank of England is created by law, and the British government can always change the laws also regarding the central bank, so they can force the central bank to play ball with it if the central bank does not want to. So the central bank, of course, it's the monopoly supplier of pounds, so it cannot run out of money. So if it supports the British government, and it's also its task, of course, to do that, it's probably also it would call itself the bank of the government or the fiscal agent of the government. I'm sure that they would. And then you see that they have a very special position. And many people in the financial press don't understand this. And yeah, you still find these ideas that there's something like debt sustainability or sustainability of public debt, but that concept doesn't really exist.
And another thing that I see from, I'm going to have to guess, neoclassical economists commentating, they get worked up about a thing called fiscal dominance. What is that?
Okay, let's first look at it from the MMT side. So what are central banks? Well, central banks are the bank of the banks. So the banks do all their clearing through the central bank, and the central bank sets the interest rate that allows those banks to borrow central bank money, which they need if, for example, if we want to see cash at the counter, or if clients of banks are transferring money from one bank to the other, then they need central bank money. And this is one big function of central banks. They are the bank of banks. And the other big function is that they are the bank of the government. So when the government spends, the government creates money, reserves, central bank deposits, and then the banks create deposits for us. And this, of course, means that whenever the government spends, you have more central bank money around. And on the interbank market, that means there's banks which have more money. And when they lend that additional money, which they don't need, to other banks, the interest rate will drop. And that means that the central banks, they have to have some kind of mechanism so that when the government spends, the interest rate is still stable, because they want to have a stable interest rate, because when it comes to being the bank of the banks, they don't want to have the interest rate fluctuating around, because the banks would be complaining and say, look, I want to borrow some money, but now it's double the price compared to yesterday. So now, of course, my expectations of profits are completely ruined. And this creates a lot of uncertainty. So I would like to have, as a bank, an interest rate which is fixed by the central bank. And when you change it, well, then you can maybe change it every 4 weeks or something, but please do announce it in advance. And I don't want to have daily interest rates. And this is why central banks have been using government bonds for many decades. I mean, now it's technically not necessary anymore, but they were using government bonds to mop up the liquidity that is created when the government spends. Okay, so the banks who receive additional central bank deposits, they then can buy those government bonds, which have a slightly high interest rate, so that there's a profit motive of banks to invest in those government bonds, and then the money is gone from the interbank market. And this means that at all times, the central bank can, on the one hand, fix an interest rate, which is stable for the banking system, and make all the government's payments, and also collect all the tax revenues, which have the opposite effect. And the neoclassicals, they don't understand this. They believe that either the central bank is engaged in monetary dominance, so they move the interest rate about to target inflation, or they are working as a bank for the government, which means that they do all the government spending part, and they see some kind of conflict there. Saying, for example, that when governments have a lot of public debt, and then for monetary reasons, the central bank increases the interest rate by too much, there would be some kind of problem with debt sustainability. Okay, then they would go on and say, look, if the interest rate is higher than the growth rate, and then we have deficits, and then the public debt level is spiraling out of control. That's what they're saying. But this idea of fiscal dominance and monetary dominance, it's nothing which is really a thing, because as I explained, the central banks always have these two functions of being a bank to the banks and a bank to the government. There's no conflict between the government spending and the interest rate setting part, which is why all this talk about these kind of issues is, again, probably just creating a lot of noise and volatility, which is benefiting the financial sector as a whole.
Is it fair to say the BOE does control the entire yield curve? If yields are where they want them to be, they just leave markets alone, and if not, they intervene. the Bank of Japan explicitly does a thing called yield curve control. But from what we've just said, it seems to me all central banks do that. They just don't explicitly say it.
Yeah, you also have to think about the market. The pension funds in the UK are forced to invest a lot of their money in gilts by law. So there is no market in the sense that there's a free market and everybody can do whatever he or she wants. So these pension funds, if you would change the law and say, well, you're now free to invest anywhere, then of course they would sell a lot of gilts and then bond prices would collapse and so on, and you would have another problem. So institutional structure matters. And institutional structure drives bond prices, and gilts are only risk-free because of the institutional setup that you have in the United Kingdom. We see Bank of England now acting as a dealer of last resort, ensuring that there are prices which are stabilized for government bonds. So, yeah, I mean, to some extent, you would be right. I mean, you could say, given the institutional structure, the Bank of England normally leaves the market alone, and arbitrage determines then the spreads between the different maturities. But of course, if the bond prices go down too much, then they will intervene and take back the reign of the market. So yeah, it's up to them to decide what bond prices will be and who's setting them.
So again, back to the ECB, you wrote on Twitter this week that Target 2 assets and liabilities are not actually assets and liabilities, but pure balance sheet entries that do not constitute a debt. Can you unpack that for us?
Yeah. So when the euro was formed, there was the question of what to do with the national central banks. What we could have done in Europe is we would have created an ECB in Frankfurt, and we would have said, okay, so all the central bankers go there. And then we have an ECB balance sheet, and there's no more Bundesbank, there's no more Banca d'Italia, no more Banco de España, there's no more national central banks. And then we wouldn't have any target 2 balances or imbalances, because then everything would be on the balance sheet, recorded on the balance sheet of the ECB. But this is not how it works. All the German banks, for example, and also the German government at all levels, they have accounts with Deutsche Bundesbank, which is the German national central bank. And there's also a Spanish central bank where the Spanish banks and Spanish government, where they have their accounts. So the question then is, what happens if a Spaniard, for example, moves 10,000 euros to a bank account in Germany? So that means that the bank of the Spaniard will just transfer 10,000 euros of reserves to the German bank account. And then the German bank will just credit the account of the receiver in Germany, let's say. The problem with this is that the balance sheets are now, they have holes now. So Banco de España now has 10,000 less liabilities because they just lost 10,000 euros in reserves, which is recorded on the liability side. So of course, if you have less liabilities, well, then you have more capital, more equity. But of course, this is not a good idea to record it like this, because the Spanish central bank is acting on behalf of the euro system, or as part of the euro system. It's part of the euro system, which is the ECB plus national central banks, and that's also the payment system, the Target 2 system. So what do we do with those balance sheets? You could have said, well, let's stop publishing balance sheets for the national central banks, because they wouldn't be complete, because they are now working for the ECB, and then we had just one consolidated balance sheet at the ECB level. But they decided to keep on publishing those national central bank balance sheets, and they were clear that we would have to fill this gap by putting in some kind of asset and liability, which would be a placeholder, let's say. It's a bit like equity, which is also the difference between other parts of the balance sheet, but it's not a thing. So you cannot point at equity. It doesn't exist. So it's just a difference between assets and liabilities. So they came up with this idea that if you lose reserves, in that place you put Target 2 liability so that you have more. So you lose liabilities, but then you gain the Target 2 liability, which means the balance sheet is still balancing. And the German central bank's balance sheet, there you increase liabilities, but you can put a Target 2 asset on the asset side. So you have now a longer balance sheet than before. You have the Target 2 asset on the left-hand side, the reserve that you receive from the Spanish bank on the right-hand side. So the Target 2 balances, they make the national central bank's balance sheet balance, and that's all they do. So they are not a debt. Why? Because they have no maturity. It's not an IOU, because an IOU has to have a maturity. Otherwise, you can just wait forever and just not pay. Okay, so if I give you an IOU saying, I owe you €1 million, and then you come to me and say, well, you owe us $1 million. Can you pay us now? I would say, well, let me see. Is there any maturity? No? Okay, so I'll pay you tomorrow. Come back tomorrow. And you will be coming to visit me for the rest of your life. Doesn't matter. We'll have a lot of fun. So that's the problem with the target 2 assets and liabilities. They're not debts. I think that was more or less clear by the end of the last decade. So in the late 2010s, I was also in the German parliament. There was a meeting of the finance committee, and I was invited to present my views on target 2. And I said that target 2 assets and liabilities would be no debts, no assets and liabilities. And Isabel Schnabel, who's now with the ECB, she was the one speaking afterwards, and she confirmed my view and said, yeah, Dirk Ehnts is right. Target 2 assets and liabilities are not actually assets and liabilities. They're just placeholders.
And so the problem that's surfacing in the commentary at the moment is because they've been given a name, that people are saying, well, look how big this number's got, basically. Just like so-called national, so-called debt shaming and stuff. Is that what's going on over there in the financial press?
Yeah, it's a blame game. So there's many German commentators who want to blame the crisis, so the Euro crisis and also the global financial crisis and everything else. They want to blame it on Southern European countries, and they use this target 2 stuff to divert the attention. And instead of looking at wage developments and maybe capital flows or fiscal stuff, they come up with this target 2 issue. They pretend that the Italians and the Spaniards would owe the Germans hundreds of billions of euros and so on. And many people don't understand what target 2 balances are, so they tend to believe what these economists have been saying. So they take it at face value when they really should not. So it's a long struggle to fight against this kind of misinformation. But I think we now see this maybe coming up for the last time, because in terms of arguments, we had the exchange, and I think it's pretty clear in the German academic scene that target 2 imbalances are not a problem. It's just how the payment system works in the Eurozone. If you would move, for example, the German banks, if you would ask them to move to Spain, for example, they would take their target 2 balances with them, which would be really odd. But then Spain would be the country which would have the large assets in terms of target 2 assets. There you can see that it doesn't really make sense to believe that these are open debts. They're clearly not.
And so the way we've been thinking about it up until very recently is that when the Eurozone member nations joined the euro, they put themselves in the position of like US states, and the ECB became the Fed. That's not quite it, is it? The ECB is not like the Fed.
Yes. So the ECB is actually not the central bank of the Eurozone, but the Euro system is. When you think about the ECB or the Eurozone, you should think about the Euro system, which is ECB plus national central banks. So all of these national central banks plus the ECB, all of them, they can create euros and then transfer euros from one central bank to the other through the target 2 system. And there's no limit. The Spanish central bank does not have to ask the German central bank for permission when a Spaniard transfers money to Germany. It just works. There's no limit. And it's also not settled at the ECB or something. So there's also, I think Nathan Tankers wrote something like this. It looked to me as if he would be writing that the national central banks would somehow settle at the ECB, but the ECB is not involved. National central banks do not have accounts at the ECB. How do I know that? I asked them a couple of weeks ago. It was a little bit funny because I asked them, so who has an account at the ECB then? And I said, well, definitely not households and firms because they don't have accounts at national central banks. And then the ECB didn't get back to me. So I asked them again. They said, okay, sorry, this just takes a while. Sorry. They're always very nice at the ECB when you ask them questions. But apparently it took them a lot of time to find out about this. So they said, okay, who has accounts at the ECB? Well, foreign central banks for one. Okay, so the Bank of England probably has an account at the ECB, also the Federal Reserve.
In euros.
Yes. So the swap arrangements with the Fed, they go through these accounts. And then the ECB also acts as a bank to the European Commission, for example. Also, the European Investment Bank has an account there, and apparently other public institutions from the European Union. But no banks, they said. Okay, so it was always a puzzle where Gazprom Bank is actually chartered. But I think it's Luxembourg, not the ECB. But yeah, so the ECB is actually, it's a currency creator. They can create money, but they're normally not involved in monetary policy. So they determine interest rates, but banks don't borrow from the ECB, but they borrow from national central banks. So they do all the heavy lifting. And also the asset purchase programs are executed by the national central banks. So that means that, for example, the Greek central bank, the German central bank, and also the Spanish central bank and all the other central banks in the Eurozone, there's 19 of them, they can all create money. Of course, there's rules, so they can also create money on behalf of the government. So when the government makes a payment, these central banks still act as fiscal agents of the state. And they have rules saying that the government has to have an account at the National Central Bank. And whenever they spend a euro, then that account is going negative €1. And during the day, they have to go back to zero. And if they go back to zero, then on the next day, the central bank can spend again on behalf of that government. And it says in the European legal text, the European laws, it says that this is not financing because it's intraday. Okay, so there's no debt that is carried over to the next day, and this is why it's not financing. But this means that all the payments made by Eurozone governments are made by central banks creating money. So money creation is the only way that the Eurozone government can make payments, just like in the UK with the Bank of England, which always creates money when the British government spends. And that is something which I think we have now understood.
So does this mean that if you remove the requirement to issue bonds, to set an interest rate, basically, if you remove that requirement and then you stopped issuing bonds, then the countries then are no longer, they would go back to complete monetary sovereignty? Is that the right way of looking at it?
Well, I mean, what's stopping those countries to spend more money normally is that they kind of are afraid that they cannot sell bonds forever. So they think that at some point, the private banks will not develop any more appetite for government bonds. But this problem was removed by the asset purchase programs at the ECB. So the ECB said, well, whenever national governments issue government bonds, we would buy them happily. Okay, so even investors in Greece and investors in Italy, so the national bonds, the national government bonds, they're always sold in the primary market to European banks. These are the only institutions that can buy them directly from the government.
But that's recently, right?
No, it has been working like this
Then why did Greece need a bailout?
Greece needed a bailout because the ECB did not play a deal of last resort. So Jean-Claude Trichet, ECB president back then, said, well, it's not the task of the ECB to make sure that governments can finance. And then the ECB in 2010s, before Draghi came along, said, well, we will not buy government bonds. And that meant that the Greek banks thought, well, if we buy bonds from the Greek government, then how can we sell them? There's no demand for them because people expect that the Greek government cannot repay its debt. And if we cannot sell them and they go down in price, we will go bankrupt. We will be insolvent on paper. So the Greek banks, they were looking for somebody to buy those government bonds from them. And the ECB said no. So the banks in Greece said also no to the government. The government could not sell any bonds. And then they couldn't bring their account at the Greek central bank back to zero, which meant that the Central Bank of Greece was not allowed to execute payments on behalf of the finance ministry of the Greek government. That's the difference between now and then. The ECB could have done what it did with the pandemic emergency purchase program. Draghi showed that easily. He said, well, we'll save the euro whatever it needs. And just the announcement was enough to make bond prices go up again.
Okay, so just so that I have it really, really clear in my head, and also it's sort of a UK question as much as a Eurozone question. But as I understand it, when the Bank of England intervenes to buy bonds and control the yield, etc., it does so by buying these bonds off the secondary market. So it almost like sells them and then buys them back again. So in the same light, in the Eurozone, when the ECB sort of says that it will support bonds from the governments, do they do that by buying directly off the central banks of each country, or do they do that by buying it off the commercial banks, like you were saying, Dirk?
Yeah, so, I mean, the asset purchase programs are conducted by the national central banks. And I think, for example, if I'm not mistaken, PEP was done by the French, the Spanish, and the German central banks. So they buy government bonds from whoever wants to sell them to those central banks. So it's not the ECB who's doing the actual bond buying, but it's the national central banks. And yes, they are only allowed to buy on the secondary market when it comes to those kind of asset purchase programs. I think they often use repos. So they buy them with a promise to sell them back. But the German central bank, for example, I think it's allowed to buy government bonds on the primary market up to 20% of each issue, if I'm not mistaken, for the purpose of, they want to stabilize bond prices. That's why the central bank is sometimes, it takes government bonds which have not been sold at a good price, it takes them onto their own books. And those bonds it's selling later then. So the German central bank is allowed to buy government bonds directly from the government, but not for the purpose of financing the state. And that's also the case in England. The Bank of England can, of course, technically they could buy government bonds directly from the government. It's just that they're not allowed to, but you can just change the law and then they would be allowed to do that. So the Bank of Canada, for example, is routinely buying government bonds directly from the government. There's no problem with that.
So why, during the Greek crisis then, were the banks worried that they couldn't sell the bonds? Why couldn't the Central Bank of Greece buy those bonds?
Because the Central Bank of Greece is not allowed to do this. Okay, so if you are a national central bank in the Eurozone, you can engage in all kind of monetary policy operations, but they are part of the Euro system, and the Euro system is making the calls. So of course, you can decide that the Central Bank of Greece will buy government bonds from the Greek government or from the secondary market, but you would have to have a majority within the ECB directors, because they would be deciding this. So yeah, the Central Bank of Greece technically was always a currency issuer, but they were not allowed to buy government bonds from the Greek government. And that was enough to stop the Greek government from having access to payment, more or less.
Okay, got it.
So just to round this off, I'm going to round off with a really big open-ended question here. I wanted to call this episode, Do Markets Control Our Politics? So Dirk, big question. What do you think?
That's a very good question, just like Patricia's. So markets do not control interest rates and prices and all these kind of things. They don't control governments. The governments, they are in full control. They are the currency issuer. And if they want, they can give this currency issuer thing to the central bank. They can insulate it from pressures, from political pressures of raising or lowering interest rates. And then you get this kind of independence of central banks when it comes to setting interest rates. But of course, central banks are creatures of the law. So if you change the central bank law, you change the central bank. And because central banks create money on behalf of the government when the government spends, there's nothing that can go wrong there. So as long as you do not fix your currency to another currency or to gold, or you have government bonds in foreign currency, then there's nothing really that can go wrong. That, of course, does not mean that exchange rates have to be stable or something. Okay, so it's a little bit like saying if you have a road network, once it's there, you can use it. Okay, so it's the same with the payment system and the government. It does not mean that you won't have any accidents. Okay, so yes, of course, the exchange rate can go up and down by 5 or 10% in a week sometimes. I mean, that's entirely possible. And of course, also in the United Kingdom, theoretically, you could have hyperinflation. It's not impossible, but the governments, they are in control when it comes to the creation of money, when it comes to the creation of resources, and the question of whether the British citizens want to sell stuff to the government and work for the government, that's of course something different. So I would say that the governments are in full control, and markets are maybe nice to have. When it comes to government bonds, they don't really have a function, I would say, because there's no such thing as government debt sustainability or some kind of fiscal sustainability. All these worries about the deficit are misplaced. So yes, deficits do something to the economy. They mainly mean that you have injected a lot of money to the private sector or maybe to the foreign sector, or both of them. Deficits do matter. It's not like they don't matter. But the question of how the government pays, I think that's settled for the United Kingdom as well as for the Eurozone. It's settled for the US and also settled for Sweden. So we have a lot of MMT material where these institutions are described and how the systems are set up to ensure that governments can always spend. Because in a democracy, this is really the most important thing, that when you have a budget which is created by the government or drafted by the government, and then the parliament has you have some kind of majority, so you have accepted the government budget. Of course, then you need to spend that money. That's the whole point in a democracy. If you can't have the money, you will not have the power. And that, of course, will destroy our democracies.
I think that perception of what the government is doing is just as important of what the government, apart from what the government is actually doing. I think you and I, Christian, we know that if this government was to stick to their guns and just stay put in with the awful fiscal policy that they're imposing, they could get away with it technically. The point is, politically, it may not be sustainable. It really depends on what group they annoy. And I guess if you can call that the market, I don't think you can call that the market, but it depends on what interest group really you're messing with. And the exchange rate in Britain is something that is a matter of pride as much as a practical issue. And as I think Warren also highlights kind of the dominance of exporters in the UK economy, and also the pension funds, I guess, this time.
I think what you can do functionally with the monetary system is something else from what you can do politically. I think that conservatives would get away with much more expansionary fiscal policies, for example, than governments from the left, which is, of course, a huge political problem. But this is not written in stone. So, of course, if people would understand more about modern monetary theory and what it means for their lives, there's this new book by Randy Ray, for example, now, How to Save America with MMT, roughly. If that succeeds, then, of course, you have more political space to use, which would be great to have. And we have a lot of problems in our societies, which you can only tackle using more money, using your more resources and bringing down unemployment and creating more jobs that are well paid and so on. So there's lots of potential, but we need to get away from this Thatcher Reagan kind of myth that there's only taxpayers' money. So this, of course, is something political, which reduces the political space for governments who are well-meaning, both of left and right.
And I'm convinced that if Liz Truss's policies had been aimed at equally expansionary, but aimed at benefiting, the working class, they would have probably been met with a similar kind of antagonism. And I think I think this is quite indicative of the kind of resistance that the left would also face.
From the
commentariat, from mainstream economists, from the Financial Times, from The Economist, from basically every mainstream liberal economic magazine out there. And I think that we can look at it as a means of informing how they may react as well to a left-wing government. Because they say, the IMF says is about, they're warning against inequality, and there's an element of that. But really what bothers them is the expansionary fiscal policy.
Yeah, but the markets are something else entirely. They want to make money. If the government would increase wages for the lower 99%, for example, that means you have a lot more potential profits. So you would move your money there and expect to be rewarded. So of course you can talk and say one thing and then you act and do another. And that's what I would suspect would happen in a case that you would have a fiscal expansion based on propping up purchasing power of the masses. But yeah, the commentaries will still be the same. I don't think it will change. So it's part of politics, not really economics. But we know that. It used to be political economy, and that was for a reason.
I think that's a great place to leave it. We've been speaking with economist and author Dr. Dirk Ehnts, and we'll link to where you can stay current with his work in the show notes for this episode. But for now, thanks so much for joining us again today on the MMT podcast, Dr. Dirk Ehnts.
Yeah, thanks to you too. It was a pleasure.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month, and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you. In the mainstream comedy.
That's a Freudian slip.
Exactly.